more upside. Believe it or not, the charts of silver and gold have roughly the same upside potential. So I would naturally go say we'll trade gold because it has a higher probability of hitting it and it has less volatility, meaning you don't have to ride quite the roller coaster, which means you can put more money to work. You can make the same amount of money as silver, more or less. People don't want to hear that. They naturally think silver outperforms dramatically, but really this year, silver has only outperformed gold, really just like 8 or 9%. And it has been a hell of a roller coaster ride if you hold silver. So gold to me has got the most. I think it's got 15 to maybe even 30% upside from where we are right now. The stock market, I think it might continue to grind a little higher if the big techs can keep dragging it up. But small caps, mid caps, more or less equal weighted stocks have all hit resistance. So it needs to be the large tech that drag the markets higher. Well, there's definitely been a very nice run. I mean, just looking at the gold chart of this last consolidation and then this run up to this bull flag pattern, using technical analysis, Fibonacci extension, gold has had a perfect move so far. So just based on the way the universe works, using Fibonacci sequence, we have a move up, we have a move down, and based on Fibonacci sequence, we should expect price to run up to the 618. This is called the golden ratio. If you don't know much about Fibonacci, go look it up. It is extremely powerful. And my general rule is if price pauses at the 618 level, then we almost always go up to the 100% measured move afterwards. So I have about 4,100 as the next upside target for gold. We've had this nice run. You and I actually talked about this level last time we were on. And that's kind of where gold is headed. I think we're going to see it potentially hit 41. It could actually blow past it. But you make a really good point, David, that, we have seen this massive move in the precious metals space, and the monthly chart gives us a really good view of just how much this thing has screamed higher and how much gold is telling us something bad is likely to happen in the world, the economy, or something is going to happen. People are moving more so, they're kind of moving away from the stock market. Even though the market's going to all-time highs, we're definitely seeing the majority of money moving into physical gold. Ray Dalio was on Diary of a CEO, and he was talking about there's like 5 forces and this 80-year cycle that's at play. And we're coming to this major turning point. We've got internal conflict. We got the left fighting the right in extreme ways. We've got people not trusting the systems anymore, that the government's protecting them. We've got currency problems. So gold is a good representation that we're about to go through this huge life cycle. And it's telling us, physical metals is the place to be. We're in that perfect storm.
Gold isn't just moving on charts. It's responding to deeper global forces. Billionaire investor Ray Dalio points to an 80-year cycle of change, marked by political polarization, weakening trust in institutions, and mounting debt crises. These fractures are pushing investors away from traditional assets and into safe havens. Physical gold demand is rising even as stock markets hit record highs. The contradiction is striking: optimism in equities, but caution in real assets. This flight to safety suggests investors expect turbulence ahead. Historically, such demand signals not only fear, but also a broader loss of confidence in financial stability.
For metals. But we do need to know that when things go parabolic, as you said, and they start to shoot higher, it can end very abruptly, and it might have a big pullback. And a good view of this, we can come back to this chart after if we want, but look at GDX. Look at the large cap gold miners. This is called a parabolic move. It is just going straight up. If we look at silver miners, we have the monthly chart. They're shooting straight up. And if you notice what happens after every straight up move, usually it ends pretty abruptly. The question is, when is it topping? These things are at all-time highs. There's no need to get out yet, but you need to be mentally prepared that, hey, if this does turn, it is kind of a crowded play now that people could unload and exit very quickly and create a very sharp drop. So this is like the bit of the warning sign that when things go straight up, and like I have this huge wave right now of people emailing us and talking about they have FOMO. They want in. They're asking me what stocks and what precious metal ETFs can they buy to take advantage of this. And really, those are the people who aren't in, and now they're willing to pay a premium. They're willing to pay nosebleed pricing, and usually that's a sign we're close to a top. And if I say anything negative on the precious metal space, like we might be coming into a little bit of a blow off top here, I'm going to get my my head ripped off in the comments, which is fine. But that's one of the indicators that everybody says gold is going to the moon. This is totally different than last time, and every time it is a bit different than last time. But the signs are here. When you look at price action, you don't want to fight this trend. It is clearly up, but this type of move usually ends in a very abrupt reversal and a very long red candle and catches a lot of people off guard. So
the rally in precious metals has spread beyond gold into silver, platinum, and palladium. Mining stocks and ETFs are soaring, showing parabolic moves that rarely last. Similar patterns in the past often ended with abrupt corrections, trapping latecomers who rushed in out of fear of missing out. In recent weeks, new retail buyers have been asking about ETFs and junior miners at stretched valuations, a classic sign of crowding. When everyone believes prices can only go higher, markets often deliver a painful lesson. While the trend remains up, the risk of a sudden reversal is becoming harder to ignore.
It doesn't matter how you look at the precious metal space, money is dumping in. And one other quick aspect here is platinum and palladium have both exploded. We have platinum taking off. And if we look at palladium ETF, these are just the ETFs on them. They have really popped and taken off in the last few days. Palladium, not quite as much, but everybody's just moving into all things precious metal right now. They don't care, and they're piling in. And you just have to be aware. It feels a little crowded of a play. A pause or pullback, depending on how it does that, could be a very bullish sign. It could be an opportunity to get in or add more before it goes higher in the precious metal space. But if it's a reversal type of candle or pattern, you might want to buckle up and protect some profits, because it might actually have a bit of a precipitous unwinding event as well. You and I have touched on this. Hopefully people can wrap their head around this chart. It's a little noisy. So this is a good example of kind of what you're talking about. 2007, the stock market topped. We saw the candlestick chart in the background. That's the S&P 500. And I've drawn lines to where the stock market put in the top. Gold was screaming higher. And we have the stock market at all-time highs right now. Gold is screaming higher on our current chart where we are. Eventually, if the music does come to an end here and we see some type of reversal, some event hits and we see it roll over, we could see the stock market sell off fairly abruptly, but gold can keep shooting higher. And that's why I really like gold, is because for the first wave of massive selling, of bad news, whatever's going to hit the market, gold is seen as that safe haven place. So I think we still can see a big push up in gold, 4,100, maybe even 4,500 for gold.
History offers a cautionary parallel. Before the 2008 crisis, U.S. stocks hit record highs while gold quietly surged in the background. When the stock market collapsed, gold became the ultimate safe haven. Today's charts look eerily similar. Equity indices hover near peaks, but gold's rapid ascent suggests hidden stress beneath the surface. The dollar's weakness amplifies this move, though in crises the greenback often stages a powerful comeback. That tension between a fading dollar narrative and its safe haven reality could define the next phase. If markets stumble, gold may rise even higher, while stocks face a harsh reckoning.
But I do think eventually we could see a very big market correction. And the green line on here is the dollar. And of course, the dollar is trading, at very big lows. It's very much hated. It's the same where we are right now. We've got the dollar trading down. Nobody likes it. Everybody thinks it's going to be worthless. But I think somebody told me yesterday or this morning actually about, I think the administration was talking about, they gave like the green light for World War III, which I'm not caught up on that, but here they were saying how it could spark the dollar to become very strong. And the dollar has put in a very strong bounce and rally. Especially if you're a Canadian investor, it's looking pretty good for a Canadian investor that the dollar is going to strengthen, the Canadian dollar is going to weaken. So you want to hold US dollars. But anyway, we could see in chaos, in difficult times, the US dollar does tend to rally. The US is still a powerhouse, and the dollar seems to shine when there is massive uncertainty. So, I mean, when you look at it in a nutshell, when gold is outperforming, just like you mentioned, in fact, our infographic shows here, precious metals tend to perform the best right near a major stock market top. And that's what we're seeing. And even if we look at the business cycle, which this is where I think we're coming into a big, some type of weak economic cycle, something I think is going to hit that causes a problem. We're in this innovation and adaptation phase. The innovation right now is AI, and AI just happens to be the largest tech companies dragging the indices higher, and making it look like this market's really strong. And this usually happens just, right near a major stock market top. And a good example of this, David, is if we take a look at the IWM. If we take a look at the IWM, this is the small caps. They are testing and trading right up near all-time highs. We're putting in potentially a triple top for the majority of stocks. And this is why everybody's really bullish right now. They're piling into small and micro cap stocks, trying to make as much money as they can. And people don't realize, like, every time we've gotten here, we've seen a huge sell-off. The other one is IWC, which are the micro caps, even more aggressive traders. It is coming right up into a significant resistance area from 2021, when everybody else was piling into all these to make as much as they can. Like, aggressive traders are moving into these. It's not a bad thing. I mean, people want to move to where the money is, but we also need to know it is running into resistance.
Market sentiment indicators are flashing red. The VIX, Wall Street's fear gauge, is near historic lows, showing extreme complacency. Meanwhile, the put-call ratio reveals traders are overwhelmingly betting on higher prices using leverage. These conditions often precede corrections. Small-cap and micro-cap stocks are approaching technical resistance, suggesting retail investors are chasing risky bets just as institutional money is quietly stepping back. The AI-driven boom in mega-cap tech masks underlying weakness in broader markets. It's the same late-cycle pattern seen before previous downturns. Optimism at the surface, stress underneath. Gold's surge may be the clearest warning signal of all.
And if we look at the equal-weighted S&P 500, which is the that is the RSP ETF. So this is the S&P 500 without the big tech heavyweights. We're kind of pushing in. Let me just zoom out a bit here. We're pushing right back into these highs that we saw just earlier this year. Let me just zoom in, and it's starting to look like it's stalling out. So the majority of stocks are slamming into resistance, and everyone is really bullish. They feel like the market's going to scream higher. That's usually a warning sign. And when we look at the VIX is trading very low. I'll go back to the daily chart here. If we look at the VIX, when the VIX is low, it's time to go. There's not a lot of fear in the market. And the biggest thing right now is a short-term indicator is the put-call ratio. Now, the put-call ratio, this looks like a noisy, messy chart. People are like, how do you even look at that? The key for this really is just to look at the 5-day moving average. Whenever the 5-day moving average gets down to this lower level, and it's actually much lower than it typically gets, that's telling us a lot of people are buying call options. They are betting and using leverage for higher pricing. And that's what everybody's positioned for right now. And it's a contrarian indicator. When everybody's long all the aggressive stuff, now they're buying options on it. Usually we're going to see some type of bit of a pullback. And that's what I think we started to see yesterday. I think we hit that FOMO extreme. Everybody just who couldn't handle missing out on the rally for metals and the stock market got in yesterday. And I think the big institutional players, they started to sell into it. They're like, okay, we just hit that threshold. Let's start to sell into these people who feel like they have to get in. And these indicators tell us we should expect some short-term weakness in the market.
Looking forward, gold still has room to climb, possibly 15 to 30% higher, while silver follows with greater volatility. But investors should expect turbulence. A pullback could offer opportunities, or it could mark the beginning of a larger unwind. The broader market's reliance on tech leadership, combined with overextended positioning, suggests fragility. History shows that gold shines brightest when uncertainty peaks, especially during financial shocks. Whether this is the start of a long bull run or just a blow-off top, one thing is clear. Gold is once again signaling that global markets are nearing a major turning point.
I think gold has more upside. Believe it or not, the charts of silver and gold have roughly the same upside potential. So I would naturally go say we'll trade gold because it has a higher probability of hitting it, and it has less volatility, meaning you don't have to ride quite the roller coaster, which means you can put more money to work. and you can make the same amount of money as silver, more or less. People don't want to hear that. They naturally think silver outperforms dramatically, but really this year, silver has only outperformed gold, really just like 8 or 9%. And it has been a hell of a roller coaster ride if you hold silver. So gold to me has got the most. I think it's got 15 to maybe even 30% upside from where we are right now. The stock market, I think it might continue to grind a little higher if the big techs can keep dragging it up. But small caps, mid caps, more or less equal weighted stocks have all hit resistance. So it needs to be the large tech that drag the markets higher. And, they're not showing the strongest kind of sign right now. When we look at the MAGS ETF, let me see here. The MAG ETF is clearly in an uptrend, but it is actually showing a little bit of weakness, short-term weakness that it might want to pull back a little bit. So I think gold, physical gold or a physical gold ETF is the play. And yeah, that's where the opportunity I think lies right now.